Hi, this is Alan Gassman. I'm a tax lawyer in Clearwater, Florida, and this is Brandon Ketron. He is a tax lawyer in Clearwater, Florida, who actually knows the tax law. And we welcome you to this talk, Nuts and Bolts of Federal Estate Tax, Part 2, because quite frankly, I didn't cover nearly as much of it last week as I wanted to. We're going to cover more this week, and then next week, we're going to talk about some of our most favorite and unique trust and will clauses. Please note, this presentation does not qualify for continuing education credit, and if you tell accreditation authorities that you've taken this course, they may actually take away your license or take away some of your credits. In 1 hour after the webinar ends, you will receive an email. It'll look like this, and it will provide you with attachments. It will provide you with, I believe, the slides again, and it will provide you with a link where you can go to YouTube and watch this an unlimited amount of time. And anyone who watches this 100 times and sends us an affidavit that you watched it 100 times will be featured in a Thursday report. So how to ask a question on the GoToWebinar slide. You go to the questions panel. You see that? It won't be circled in red, but you do see the questions panel. You click on that little triangle, questions, and then you type in the question. The best question is, how can you guys be so smart? This is the best program I have ever seen. That would be a typical question that you might want to ask us. Now, we have some questions here on page 5 that we will get to at the end of the program. And if you email us a question, just let us know. And thank you to James Tollerton for asking the first question, which is, do you always work on Saturdays? And the answer is, do you call this work? Also, you will be able to find us on YouTube. We don't dance or sing because we got censored for doing that last week, but instead we just talk about tax and other things. One of our better YouTubes was Tuesday, June 22nd. Oh, I'm sorry, you can see this at CPA Academy. It's a 60-minute hot topic talk. If you click on CPA Academy, it's free of charge and worth every dollar of it. Okay, let's stop with the shameful self-promotion and get on with what we want to talk about. There's a lot of things that we can cover, and I just want to turn my phone off there and go through some of these tools that we use. We're going to cover some more than others. One tool that does exist is that if a person dies and they don't use their whole $11,700,000 exemption, then their spouse can file an estate tax return within a certain period of time and have that exemption. So the exemption would go up from 11,700,000 to 23,400,000. Or if you die this year and your spouse's exemption goes down to 3,500,000 because the Democrats sweep the Senate in 2022, then the exemption would be the sum of 11,700,000 plus 3,500,000. But the problem with portability is if the surviving spouse remarries and the new spouse dies first, then you lose your portability allowance from the prior spouse and you get the portability allowance of the new spouse. So if the new spouse dies after 2026, when the exemption has gone down, or if the new spouse is wealthy and leaves all their assets to their children, then you don't have any portability allowance. Also, the portability allowance does not grow with inflation and does not allow for generation skipping tax planning. So yes, it's a tool, but not such a good one. We don't like to rely on it. Now, number 2, another tool we commonly use that we don't talk about that much on these webinars is the JES Trust, the Joint Exempt Step-Up Trust. And I'll give you an example as to why the Joint Exempt Step-Up Trust could be important. Let's say that I have $7 million of appreciated assets. My wife has $7 million of appreciated assets, and we're both high earners. So obviously it's a fictional couple, not my couple. But anyway, you want the full 11,700,000 locked up in a credit shelter trust on the first death, but these people only have 700 each. So if they have separate trusts that become irrevocable on the first death, when the first spouse dies, there's only 11 million, there's only 7 million. The other 4,700,000 hasn't been used. That becomes a portability allowance, which may be lost. Also, when one spouse dies, the 7 million in assets get a new fair market value date of death basis. But the spouse who survived still has appreciated assets, and when she sells those assets, she'll pay a capital gains tax. With the joint exempt step-up trust, you can put the $14 million worth of assets into one joint trust, and on the first death, the first 11,700,000 of the 14 locks up in an irrevocable trust, and the whole 14 million worth of assets gets a new income tax basis. So it's called the Joint Exempt Step-Up Trust. If you want to read about it, you can Google JEST Gassman, and I've written articles about it and sort of helped to invent it. Now, the third thing that you can consider, if you're in a community property state, which most notably include California and Texas and Louisiana. In a community property state, when one spouse dies, all the assets get a step up if all the assets are what we call community property. Tennessee and Alaska have a community property trust law, which says if you put your assets in a Alaska or Tennessee trust and designate it as a community property trust, you get the full step up on the first spouse's death. And that works just as well as the GEST, maybe even better. So Florida has just legislated a community property trust statute. It's passed our House and Senate. The governor has not signed it, but I believe it automatically comes into law even if he doesn't sign it on July 1st. So you'll see a lot of information on community property trusts, and I'm working on a pretty long article comparing the GEST trust to the community property trust. So the tool I've just suggested, which is really important, and we see a lot of people who don't use it properly, is the credit shelter trust, which is on the death of the first dying spouse, the amount that can pass estate tax-free, usually being 11,700,000, does not go outright to the surviving spouse, goes to a trust. The surviving spouse can be the trustee of the trust, could even receive whatever he or she needs for the magic words health, education, maintenance, and support. And that trust will never be subject to federal estate tax on the surviving spouse's death. The surviving spouse can have what's called a limited power of appointment, the power to direct how the trust assets go on the surviving spouse's death. And that limited power of appointment is usually exercisable only in favor of the common children of the clients, or could be broadly in favor of anything and everything other than the surviving spouse herself, surviving spouse's creditors, the surviving spouse's estate, or the creditors of the surviving spouse's estate. So that's called a limited power of appointment. And in some families, it is called the power of disappointment. Because yes, my spouse died, left me this trust. On my death, it has to go to my descendants, but only to the ones who remember me on Christmas and Hanukkah, not to the others. Big question, should the power of appointment be exercisable in favor of a next spouse? Let's say that my spouse dies and I marry a new spouse, and that new spouse just puts up with me and takes great care of me. And wouldn't my spouse, who has predeceased me, want to reward someone who I might marry who might take great care of me for many years? And the answer to that is, of course, absolutely not, but just think about it. Or what about that wonderful son-in-law or daughter-in-law who has done more for me than any child I've ever had or imagined? Should they be able to inherit something? should, when I leave my assets in trust for my children, should my children only be able to appoint assets for their descendants or my descendants? Or what about a long-term spouse? What about charities that I've supported? How do you prevent people from being abused by aggressive charities? The list goes on, but the key we find is that if you leave assets outright to people, they have a much higher risk of being lost or misused than if you leave assets into lifetime trusts. And if you leave assets into lifetime trusts, you can also put some provisions in there and say, hey, can't take out more than 80 grand a year until you're 65 unless you really need it. And plus what you need to educate your children. I'm not here to screw up your life journey. Don't ruin your child's life by making it too easy. So Brandon, I've already spoken now for 4/10 of a billable hour. You want to take numbers 5, 6, 7, and 8, and I'm looking forward to what you have to say.
Yeah, so number 5, the use of a Clayton Q-tip trust is a way to kind of retain the ability to make that credit shelter trust that Alan spoke of into a Q-tip type trust by making an election after the death of the first surviving spouse. So that can be used if estate taxes maybe is not a concern. It would include the assets in the surviving spouse's estate, allow for that step up in basis to occur. So that's one way you can use a Clayton Q-tip type trust election. Number 6, use of LLCs, limited partnerships, other types of entities. We spoke about this a lot. We have some slides in the PowerPoint as well that go into more detail on this, but this can be really important. Number 1, from a creditor protection standpoint, if you put assets into an LLC, have multiple members, you have what is known as charging order protection, where a creditor can't liquidate or reach into the LLC, but can only receive the right to receive any distributions that are made from the LLC, but no right to force when those distributions come out. So a nice negotiating tool when you have a creditor to use and say, hey, I don't have to ever make any distributions from this LLC. Can we settle for pennies on the dollar? Because it might be a long time before you get anything. They can also be valuable for discounting, for making gifts, and for estate tax planning purposes. If you make gifts of non-voting interest in the LLC, you can take a discount on that, maybe as much as 30% on the value of the assets held under the LLC. There's certain requirements that you have to meet. You need business purpose for this. You need to fund the LLC well in advance of making the transfer to make sure you don't run into any step transaction issues, but can be a nice way to reduce estate tax. Number 7, irrevocable trust to receive crummy power gifts. When you make a contribution to a trust, you can give the beneficiary the right to withdraw the assets of that trust for a certain period of time. It's known as a crummy withdrawal power. And what that does is qualify the gift to the trust for the annual exclusion of $15,000 each year per donor or per donee. So if you split the gift with a spouse, up to $30,000 can be gifted to a trust each year for one beneficiary. If there's 4 beneficiaries of the trust, $120,000 each year can go gift tax free. So a nice way to transfer small increments each year and reduce your estate and not pay any gift or estate taxes on that. Life insurance trust, very important tool as well. You can put life insurance into a trust. Maybe premiums are paid through the use of crummy annual exclusion gifts if there's enough beneficiaries there or to support the premium payments. Or you can do what is known as a split dollar agreement, where you essentially would loan the money to the trust to pay the premiums. On death, the death benefits would first be used to pay off the loan with a little bit of interest, and the excess could pass estate tax free under the life insurance trust. So very useful tool to get life insurance outside of your estate. So Alan, I'll kick it back to you. You want to talk a little bit about slats and or other tools, or mention anything else on these?
Yeah, I'm gonna go back. I'm gonna go back over some of these because we got some good questions here. So David asked me to confirm that the portability allowance cannot be generation skipping tax exempt, and that is correct. So if I want to benefit my children and not have them subject to federal estate tax when they die, then the best use of my $11,700,000 exemption whether it's on my death or during my lifetime, will be to fund trusts that can benefit my children without being subject to federal estate tax upon their death. And Congress doesn't like that. Congress wants wealth to be taxed at every generation. So they invented the generation skipping tax long ago. And the generation skipping tax says that if you leave assets in trust beyond a certain allowance, and they are there when your children's generation all die, then there will be a separate tax imposed. So for example, if a client dies and leaves $20 million directly to her grandchildren, then there will be an estate tax on the 20 million, and then a 40% generation skipping tax to the extent that she leaves more than her generation skipping tax exemption to the grandchildren. And the generation skipping tax exemption is, you guessed it, 11,700,000. So in my example, she'd pay estate tax on the whole 20 million. Then the net amount above 11,700,000 that went to the grandchildren would be subject to another 40% tax. And you can avoid the generation skipping tax by putting assets now into an irrevocable trust. If I put 11,700,000 into an irrevocable trust today, it's all GST exempt, we call it. If it's worth 30 million when I die, then that whole 30 million can benefit my children and never be subject to estate tax at their level. So that's but you can't do that with portability. If my spouse dies, I may have a $23 million estate tax exemption, but I only have an 11,700,000 GST exemption. So David, thank you for asking me for that reminder. Okay, then Chandresh, welcome. Haven't seen you in one of these before. Chandresh says, how can I get access to last week's presentations? Well, all you have to do is go to YouTube, search Gassman, YouTube, estate tax, and you can scroll and you'll see our library. And last week's presentation is there, but it's not a very good presentation, Chandresh. There's pretty good music videos instead. All right. Well, let's mention gift splitting. We go back to number 7. So I have a trust for my granddaughter. I want to put assets in that trust. I don't want to use up any of my estate tax exclusion. So I put $15,000 in the trust. I send my granddaughter a letter that says you have 30 days to withdraw the $15,000 that I just put into the trust. My granddaughter's only 3 years old, so she doesn't read the letter. She doesn't make the withdrawal, but she had the right to receive the withdrawal. And therefore, I don't have to count that $15,000 gift against my exemption. Let's say I'm married to someone and I put $30,000 into that trust. If my spouse will sign a gift tax return agreeing to allow half of that gift to be considered to have come through her, then I will be able to gift $30,000 to that trust for my grandchild. So if you have a lot of assets and your spouse doesn't, or you have a lot of assets, you want to make gifts to your children, and your spouse doesn't want to make gifts to your children, then gift splitting can be very important, and it's something that we sometimes require in a pre-nuptial agreement. So that is gift splitting. So that pretty thoroughly covers our first 8 items. And what I want to make sure we cover today that we really haven't done a good job covering for you before is the qualified personal residence trust and the charitable remainder trust and the charitable lead trust. And we have about 25 minutes to do that. So let me go ahead. You have a lot of slides here that you are welcome to use as you would like to use them. And for those of you who are CPAs, we have polling questions, but you don't have to answer the polling questions because there's no credit here. But I'll give you a secret piece of advice. The answer to every polling question is D, all of the above. So you can always read the polling questions, and the answer is always D, all of the above. But Brandon, do you want to lead us through the qualified personal residence trust slide?
Yeah, so this is an example here that we have on the Cupert and how to use the qualified personal residence to potentially save some estate tax. So the way the Cupert works is you can set up a trust for a period of years. So this example is a 10-year term where the client can contribute their home plus maybe one vacation home. You can do this with up to 2 properties and retain the right to use the home for a number of years. So in this example, it's 10 years. And then you look at the actuarial value of what that retained interest might be. There's tables and there's software to calculate what the actual gift to the trust is deemed to be. It's not going to be the full $2 million value of the house because you are giving away the remainder interest of the trust. So here the gift is equal to 1.2 million approximately, based upon the tables that the IRS publishes. So they've made a transfer of a $2 million home for only a $1.2 million gift. The benefit here is whatever that home grows to, it's always going to be that $1.2 million gift. So the appreciation of the property can pass estate tax free. The other benefit is after that 10-year term, the spouse is going to have to start paying rent to use the property, and the rent is paid to the trust for the descendants, and that's also not considered to be a gift. So that rent would further reduce the value of the estate and could grow estate tax free as well. So to go into a little bit more detail, I think it's best to look at this chart here. So typically the way this is done is we do 2 Cuperts, one for each spouse. So spouse 1 would take their 50% of the home, valued at 1.8 million, so $900,000. But 1/2 of a home isn't worth the value of 1/2 of a home. Who wants to buy 1/2 of a house? So you can take a little bit of a discount on that. 15% might be reasonable. So that 50% ownership might be worth $765,000 instead of $900,000. If you look at the actuarial tables for a 10-year term for a spouse age 77, that's a $343,000 gift. The other spouse does the same thing. It's a little bit younger spouse. So the value of the gift's going to be a little bit more because the remainder interest is expected to be a little bit more. So that would be a $680,000 gift on that $765,000 value of a home. Both of these are for 10-year terms. They can use the property for 10 years rent-free. After the 10 years, the Cupert 1 could possibly be a trust for the benefit of spouse 2 and children. So at least you would not have to pay rent on 1/2 of the property, since spouse 2 could potentially use it rent-free as a beneficiary of the trust. And then for the second Cupert, you would have the spouses paying rent to the second Cupert for the use of that 1/2 of the property. Now, to go into a little bit more detail on the numbers here, the 10-year term with the 15% discount is the second to bottom line there on this chart. So we have the gift of the take a 15% discount. The gift is valued at $343,000. The value of the home might grow to 3.2 million. So 1/2 would be 1.6 of that after that 10-year term. The difference between the value at the time of the gift and the appreciation is all estate tax savings plus the discount. So we saved roughly $645,000 after the end of the 10-year term in estate taxes. Now, if we pay rent, and just assuming that the value of the rent paid is 8% of the value of the property, we pay the rent for 20 years, that's another close to $1 million that's transferred out of the estate with the rent, which would equal another approximately $400,000 of estate tax savings. So after the end of all this, at 20 years, paying rent to the trust for 10 years, we have total estate tax savings on the far right of 1.4. So the Cupert can be a very valuable tool, fairly simple to set up, and nice estate tax savings if the house appreciates and the grantor does survive the term of the Cupert.
So I'm going to show off our Cupert spreadsheet, and I believe everybody will receive this spreadsheet. It's an Excel spreadsheet, and we've made one improvement. So here we've got a 10-year Cupert, and the home begins with a value of $1 million, but you can go ahead and change that here. Just click up and down to whatever you want the home to start at. And then the rent will be based upon 8% of the value of the home, but we can move that down if you think that the rent should be lower, maybe 7%. So I've done that, and I'm starting the house at $1.5 million. It's worth 7%. Okay, and then then if you reinvest the rent money at 7%, what will it grow to? All right, and then how much of the gift exemption am I using? Well, we'll assume that on a $1.5 million home, based upon the client's age, that the gift is $1,153,000. So we file a gift tax return showing that we've used $1,153,000 of the client's estate tax exemption in the year the home is put in. Now, if the client dies, and let's make it a 12-year Cupert. So, or actually 12, there we go. So it's a 12-year Cupert. So if the client dies during the first 12 years, then the entire home is in the client's estate. The use of the gift tax exemption is reversed, so it's like you never did the Cupert. But if the client lives the 13th year and then dies in an unlucky year 13, actually it's a lucky year because she survived it, the home is now worth $2,138,000. There's been 1 year of rent paid. So the total amount out of her estate is $2,298,000. The exemption used was $1,153,000. The estate tax savings, assuming a 40% estate tax, is going to be $458,000. And if she lives 20 years, the estate tax savings is $1,160,000. Now we have to go to Tiger Tables or Number Cruncher to decide the number here, the use of the gift exemption. I don't know of another way to do that, but other than that, you can use this chart to demonstrate the savings. So that takes care of that. There's other Cupert facts here, but I think we gave you a pretty good example of how a Cupert can work. Those of you who reside in Florida, the Cupert can qualify for the Homestead Tax Exemption, both during the term of free use and also during the rental term. For the rental term, believe it or not, we put in a 99-year lease, terminable upon death or mutual note agreement of the parties will allow it to continue to qualify for the Homestead Tax Exemption. So now, Brandon, I want to make sure that we cover the Charitable Lead Annuity Trust. And the Charitable Lead Annuity Trust is an irrevocable trust, which basically says, give a certain amount every year to charity, and whatever's left at the end of the trust term can go to my children. So if, for example, I set up a Charitable Lead Annuity Trust and I put $1,210,000 worth of assets into an LLC, and then I decide to give the 99% non-voting member interest in that LLC to a Charitable Lead Annuity Trust, I've given a gift of $846,000 worth of value if I assume a 30% discount. Now, my gift to the Charitable Lead Annuity Trust will give me a $846,000 income tax deduction if it's properly drafted and I'm living. Now the Charitable Lead Annuity Trust, based on the formula within the trust, will pay $100,000 a year to charities for 10 years, and the charity could be my family foundation. So $1 million goes to charity, And at the end of the 10th year, what remains in the charitable lead annuity trust goes to my children. And Brandon, how much of my estate tax exemption or my gift exemption do I have to use to fund the charitable lead annuity trust?
None, because basically what happens here is you get I guess the charitable deduction for the extent that the charity is receiving money here. So $1,000 or $100,000 a year for 10 years, you would calculate the present value of that, and that is actually equal to 846,846, which is the value of the transfer. So this is what is known as a zeroed out CLAT, similar to a zeroed out GRAT, which is a grantor retained annuity trust. So there's no gift deemed to be made to the trust when it was transferred to the trust. And therefore you've used 0 gift exemption, 0 estate tax exemption. And in this scenario, I think we assume 6% growth. So pretty conservative rate of return. And 848,000 was able to go gift and estate tax free to a trust for your children that would not be subject to estate tax on their death, but or actually, sorry, it would be, because I don't think we could allocate GST exemption to this in an effective way. So
Right.
that would be the only downside here to the CLAT, but it is a nice way to at least pass assets to your children, not subject to estate or gift tax in your estate.
If you are number 1, wealthy, number 2, definitely want a certain amount to go to charity, and number 3, want to avoid federal estate tax, then the CLAT is definitely your tool and your vehicle. Now, this is a lifetime income tax deductible CLAT. I must disclose that although you get the income tax deduction for the value of the contribution, you have to pay income tax during the 10-year period to the extent that the assets in the CLAT have income. And for that reason, the assets would typically just be invested in growth stocks that do not pay dividends. Then when the growth stocks are used to satisfy the $100,000 a year payment obligation, that may trigger capital gains tax that ends up on your tax return. The law is not clear on that. So people who set these up are not recognizing income tax, but if they get audited, they may have to pay some capital. They may get a big ordinary income tax deduction in the year of formation, and then pay a little bit of income tax annually as you go. So here's the numbers. You start off with $1.2 million inside the LLC. You report it as an $846,000 gift. The assets grow at 6% a year. Charity gets $100,000 a year. The tax deduction benefit is mentioned here, but what's really important is how much is in the CLAT. When you take out $100,000 a year and it's growing at 6%, at the end of the day, the children get $848,000 free of income tax.
Yeah, and Alan, just to mention one thing, there are 2 alternatives when you set up the CLAT. You could make it a grantor type trust where the grantor would pay the income on the trust and receive that charitable deduction that they could use personally. Or alternatively, you could structure the CLAT as a non-grantor CLAT where the trust would pay its own income taxes and receive an income tax deduction as distributions are made to charity each year. So there's 2 alternatives there. Depends on the client's situation and factors that go into that, which one is better and which one they prefer, but you do have those 2 options.
Now, that is a lifetime CLAT. The second type of CLAT that we are commonly using is a testamentary CLAT, which means a CLAT when you die. So when I die, I could leave everything to my daughter, or a GST trust for my daughter, and she'll get 40%. I mean, she'll get 60%. The government will get 40%. On the other hand, I could leave my assets into a 20-year CLAT. And the 20-year CLAT can say, give my foundation managed by my daughter the minimum amount every year for 20 years that is needed to completely avoid federal estate tax. And at the end of the 20th year, whatever is in the CLAT would go to my daughter. And if I leave the CLAT, non-voting ownership interest in an LLC, and I can take a 33% discount on the value of the LLC, and the assets will grow at 6%, then while my daughter has to wait 20 years, at the end of the 20th year, she will get 73% of the total value, and the charity will have gotten 27%, and the government will have gotten 0%. So you can Google Jacqueline Kennedy CLAT and see that her will said, give my children my assets, or if they prefer, let those assets go by disclaimer to a CLAT. And her children took it and paid the estate tax, but they could have used the CLAT. So if you're a lawyer here or a financial advisor and you have a client leaving everything to charity because they think that's what they have to do to avoid estate tax, they can use a zeroed out CLAT, pay no estate tax, and still leave a lot of assets other than to charity. Now, Brandon, I wanted to cover charitable remainder trust, but I guess I forgot to put any charitable remainder trust information here. So we get asked more than anything, so we'll cover this. The installment sale to a defective grantor trust. The defective grantor trust is an irrevocable trust. It's out of your estate for estate tax purposes, but it is considered to be owned by you for income tax purposes, and that can be very confusing. But it can be very wonderful because I put $1 million into this trust for my children, and the trust owns stocks and bonds which generate dividends and interest and capital gains. And because it's out of my estate, the growth is out of my estate. But because the trust is defective and therefore disregarded for income tax purposes, I get to pay the income tax on behalf of the trust so it can grow more and my estate can come down. So I could put brokerage accounts worth $50 million into that trust, into that LLC. And I could make a $5 million gift to this trust for my children so that it has ballast and it can now buy my 97% non-voting member interest in exchange for a note. And the note would not be a $50 million note. If I take a 1/3 discount, it would be 2/3 of $50,000, which would be about a $33,000 note. So where did the $17,000 go? Well, we did not charge you $17 million in legal fees. That's not where it went. It just went away. It just is gone. And that's what Bernie Sanders doesn't like about discounting. And that's what he doesn't like about a trust that's disregarded, so I wouldn't have to pay income tax when I sell my assets for a note. And then when the trust pays me interest at 2% a year, while the assets grow at 7% a year, I don't have to even pay income tax on the interest the trust pays me. I'm paying the income tax on behalf of the whole trust. And Bernie Sanders doesn't like that whatsoever, which is why he became my favorite person in the whole world when he proposed that discounts would go away and that defective grantor trusts would go away, so that all my clients who have been ignoring this or delaying this finally are willing to think about an installment sale to a defective grantor trust. Now, this trust could be a spousal limited access trust. So John puts his assets in an LLC, and this can be for his spouse. And then here's a question for you, Brandon, and this is for one client in particular who I'm going to send a copy of this video. What if the IRS says that that discount is really a gift? and says, look, you gifted 5 million to this trust, and then that note back should have been not 33 million. That note back should have been 43 million. We think you've made a $15 million gift to that trust. So we want 40% of everything over 11,700,000.
Yeah, so there's three, I think, really different ways to prevent that, and it's use of adjustment clauses, and there's three, I guess, kind of main ones that are used. The first one is known as a Keen clause, and it's more of a purchase price adjustment. So in that example, if the IRS says that the note really should have been $40 million instead of the $33 million, then the note would just be increased and the sell price would just increase.
Okay, you're right on the adjustment clause, and you're right that there's three types of adjustment clauses, but I know that the IRS still says they don't agree with adjustment clauses. So here's where I was going. Well, John Smith is married. So if this trust is only for his children, he can ask his wife to split the gift. And therefore, yes, there was a $15 million in gifting. 7.5 million comes from him, 7.5 million from her, no gift tax owed. But Brandon, if this trust is a slat, the problem is the wife can't split the gift if the IRS can show that she's likely to receive benefits from the slat.
Right.
So for this particular client with a $50 million LLC, I am going to recommend that 49% be sold to a trust for children only, and 49% be sold to a slat. And now, if the IRS says that there was a $10 million gift because of the sale, half of that gift went to the trust for children. So the wife can now split 10 million of the 15 million, and the husband is going to be bulletproof from a gift tax standpoint. But that's my explanation as to why, instead of all the sale being to a slat, it'll be half to a slat and half to a descendants trust.
That makes sense. Yep.
Makes sense. And there's a couple of these we're doing right now for second marriage situations where we're going to go back to the client and tell them that we think that this is a better way to do it. And we thank all clients for their patience with us as we run the math and try to figure these things out. So we're actually finishing on time today. That's a big favor for everybody, I'm sure. Those of you who are still awake. So now I want to go ahead and answer some questions. First, from David. So the CLAT works well when rates are low. You know, certain things work better when rates are low. Certain thing works better when rates are high. But all these things work beautifully for the right situation. So I'm not worried about whether rates are low or rates are high. These things work. Let me see here. Michael, at what point other than desire should clients consider many of the strategies discussed? What asset level or complexity does the recommendation? Well, I think if there's tax savings, it's worth the complexity. I think most clients can understand each of these items when you read the trust agreement, when you look at charts, when you look at the numbers. I think it's understandable. So I think anybody can consider doing this. Here's another one from Michael. Can a married couple split a gift without consent from each other or independently? And the answer is no. You have to have consent to split a gift. From Luis, which tools are best to use by a single person with no children and only siblings as anticipated beneficiaries with a estate of 14 million in the context of using the 11.7 million exemption? Luis, this is a perfect one. Put $1.5 million of the 14 million into an irrevocable trust for the siblings, then put the rest of the assets in an LLC, sell the 99% non-voting member interest in the LLC for a 7 million note, and now you've reduced your net worth from 14 million to 8 or 9 million, and that would avoid estate tax and make your siblings very happy. And if you use a Nevada trust, you can be added as a beneficiary if you ever need more than the promissory note that's owed to you. So Brandon, do you want to cover the questions on slide 5? I'm giving them to you because they're much more difficult than the questions that I just answered.
Yeah, so the first one on the top left here, elderly spouse, poor health, take advantage of the 11.7 estate tax exemption, funding the slat with low basis stocks. If he borrows them back in exchange for a note passes, will their costs be stepped up at death? So this is a really good question. We don't have a clear answer. There's people that have different views on this. I will say that our view is that the step up in basis is an income tax concept, and grantor trust status of the trust means that the grantor is deemed to own the assets for income tax purposes. So we think there's a position there that you could take, since they're owned for income tax purposes, that you should get a step up in basis. Other commenters say, no, this is a trust outside of your estate. No way you'll get a step up. An interesting part of the proposals that are pending in Congress is they specifically say now that assets held under a grantor trust will not get a step up in basis. So you can use that in a way to say, well, if they have to specifically say that now, does that mean it applied in the past? We think so. So we think that helps the position as well, but it could be something in the future that is definitively eliminated, but there is a reasonable position to take now. And then I think that addresses the one below about what type of irrevocable trust may receive a step up in basis. This would have to be a grantor type trust where the grantor is paying the income taxes associated with the trust. If it's a non-grantor trust, then no step up applies. The other way you can address this, though, is by having an independent party or potentially a trustee change a power of appointment that is a limited power of appointment, so assets would not be included in the estate, to what is known as a general power of appointment, where they have the ability to point assets to their creditors or to the creditors of their estate. And that would cause estate tax inclusion, but that would also allow for a step up in basis to occur. So if you have someone, maybe it's an old trust that's set up a long time ago with $3 or $4 million, that $3 or $4 million isn't going to do anything to cause estate tax because of a $20 million exemption, for example. You could convert that power of appointment to allow for a general power of appointment that would cause inclusion and allow for a step up in basis to occur. Alan, do you want to talk about this 3-year clawback potential? You know, I guess if you make a gift within 3 years, it's deemed to be contributed back to your estate, but I'm not sure what the question's trying to get to about the exemption reducing in 2026.
I don't think there's any clawback. Some people are concerned that if you make a large gift and then they reverse the law, that they'll consider you to have to pay gift tax. I don't think there's any clawback risk, so okay. I wouldn't worry about it.
Yep. And then bottom right, when the grantor pays the tax for the slat, is it at his tax rate or the trust tax rates? And it's at your individual rate. All this is reported on your individual return. There's no trust tax return that's filed other than basically an informational type return that says, hey, all the income is here, but it's reported over here on the grantor's personal 1040. So there is no trust tax rates. It's the individual rates, which is another benefit these days because the trust rates are extremely compressed, so you get to that highest rate bracket a lot quicker than you do under the individual rates. And then when the grantor dies, who pays the income tax for the slat? Then the trust would begin to pay its own income taxes as a non-grantor trust. One exception to that, though, might be if you have certain powers under the trust to make it tax to what is known as a 678 trust, where the beneficiary would actually pay the taxes. There's some complications there. I'm not sure you can maybe make it work with the slat, but that is one potential alternative where the beneficiary pay the tax rather than the trust itself.
So Brandon, we now have the risk from this proposed Biden law that somebody who dies after 2021 would have to pay capital gains tax on death on appreciated assets. if I put my assets into a slat and it's out of my estate for estate tax purposes, and I get that done this year, and the slat owes me a promissory note, and then I die next year, does that avoid the Biden capital gains tax because I don't own those appreciated assets? They're under an irrevocable trust that's no longer mine.
It depends on the effective date of the statute. I think that's the really unknown question as of right now, is when will this become effective? The one proposal that's in the House has an effective date of 2021, so that transfer could potentially be subject to capital gains taxes. The other that's in the Senate is a 2022 proposal, so if you did it before the date of enactment of the statute, that type of trust would be grandfathered and there would be no capital gains tax on death. So it's really more of an effective date question. Don't know that there's a clear answer to that as of right now.
Well, the Biden Green Book, which came out on May 26th, says that it would not take effect until next year.
Right.
So if that law passes, I think there's about a 0 chance that that law is going to pass. But if that law passes, then I think there's going to be a lot more people doing installment sales to defective grantor trusts to avoid that tax that would come into effect in 2022. Okay, Jeffrey has asked a really good question about NIMCRUTs and the use of Delaware blocker entities that we're going to cover next week. Next week, we're going to do charitable remainder unitrusts, more questions and answers, and many of our favorite trust provisions, including for Sumida. He's asking us for a clause that will provide for a 10-year stretch of an IRA under the Secure Act, and we'll be sharing our language for that next Saturday. So we thank everybody, including Morris the Puppet. We thank you for coming today to our program, and we'll be sending you a replay in just 1 hour. If you have any questions, hey you, listen to me. Are you listening? If you have any questions, you can email them to Brandon@gassmanpa.com, or the easy ones can go to Alan. Thank you very much for attending and hopefully listening, and for any questions, comments, or suggestions you might have. Thank you. Are we done?